Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. Our episode today focuses on options for investing your long-term funds and does a deep dive into portfolio management services, or PMSs, like the one we run here at Capital Mind called Capital Mind Wealth. To that end, we look at what a PMS is, both legally and practically. So what problem does it solve for you? What's the time horizon to look at and why? Do you graduate into a PMS once you cross 50 lakhs? What a PMS can do differently? And a few different customer types who we've seen really get the most out of a PMS offering. So do listen in to see if a PMS makes sense for you. So Deepak, what is a portfolio management service and what's it good for, or what's the point?
Hey Shrey, it's been a while since our last podcast, and as a disclaimer, we should say that we run a portfolio management service. So therefore, we're going to glorify it a little bit, but remember that we are biased. Think of a PMS is simply someone as an advisor who manages your money. Now, there are three different forms of SEBI registered, and this is a SEBI registered framework, right? So the three forms. All three of them require a minimum of 50 lakhs to get in. And the three forms are discretionary PMS, non-discretionary, and advisory. The discretionary means you give your money to a PMS manager, and the PMS manager then takes the decisions on what to buy, what to sell, and so on. It's completely the PMS manager's discretion, so it's a discretionary PMS. A non-discretionary is simply that the PMS manager decides, comes to you and says, listen, we want to do this. Are you okay with it? You say okay, and then they do it. An advisory is the PMS manager says, listen, this is what you should be doing. And you say, okay, well, fine, thank you very much. And you go ahead and do it. So for the purposes of this podcast, we should discuss the most common one, which is the discretionary PMS, which is typically someone you give your money to and then they go and invest it on your behalf. And they don't need your decisions their decisions to be approved by you. That's the most common part. What we will avoid right now is the non-discretionary and advisory part. But think of this in a discretionary PMS and now onwards, a PMS is you open a Demat account. In that Demat account is in your name. And you give the PMS manager your money. The money is then transferred to a custodial bank account. The custodial bank account is run by a custodian appointed, again, SEBI has a framework for this. The idea here is the PMS manager will actually purchase trades through a broker in your account. The custodian will pay for the money, pay the exchange for all the money that is required. The stocks come into your Demat account in your name, and maybe there's some residual cash left over. That cash left over sits in a bank account. Either that bank account is in your name or it's in a common pool account name with the custodian. Either way, the PMS manager has to segregate the amount of cash on a per customer basis. With this SEBI registered framework is basically the idea of a managed account. It's like your money, your account that's managed by somebody else. A PMS is effectively a little bit different in the sense from a mutual fund, because in a mutual fund you give money to a mutual fund. The mutual fund gives you units. And the mutual fund goes and buys whatever it wants. It doesn't have to tell you what it buys. Of course, once a month they give you a portfolio, but they don't have to reveal like every single trade and all that stuff. In this case, in a PMS, you actually get every single trade done in your account. So effectively, you are the one doing the trade, except you've assigned your PMS manager the right and be able to do it on your behalf. You are the owner of the underlying stock. So that tomorrow, if there's a voting in an AGM, you are the one who votes, not the PMS manager. And in that sense, it's slightly different from a PMS. It's actually a
from a
managed
mutual
account.
fund.
Sorry, a mutual fund. Sorry, yes, it's a bit like a managed account, which is what the names are called abroad. But in India, it's called a portfolio management, and it helps you invest your money.
This brings me to the question of fine, I get this. So who's the you here and who's the right type of you for a PMS?
This is actually a great point because, the typical person, in the investing world, we love to keep talking about how, money is a very interesting thing and money is, important and all that stuff. And we think that money is the be all and end all of a lot of things. But too many people, and I think 99% of people, don't have three factors. And we keep repeating this, but, I'll say it again. It's you need the time, inclination, and skill. That means if you have all three, that's when you want to invest your money. You need to have the time to invest. You need to have the inclination, which means you need to be really loving this stuff in order to be able, think of, a lot of spreadsheets and calculations and all that stuff. If that's your thing, that this is the inclination. And you need the skill, which is something that comes over a period of time. You understand when investing means certain things and so investing doesn't mean certain things. If you don't have all three, your next thought process is, listen, I don't want to do this on my own. I either don't have the time, the skill, or the inclination. I will need to give it to somebody else to invest. Now, this is our primary use case. Now, of course, we are talking of the HNI crowd in the sense that we are saying that if you don't have 50 lakhs, you can't even start with a PMS, whereas you could start with a mutual fund with anything. But a PMS is like a minimum 50 lakhs and above, and you want someone else to take care of your long-term wealth.
Fair. How long is long term? Because I know people keep asking that question.
Oh, yeah. In fact, honestly, to a person who's trading intraday, 1 day is long term. And but I typically say, the industry definitions may vary. But in my mind, you have to go through a business cycle in the equity markets for it to be long term. You probably have to go through a fixed income cycle of interest rates for it to be long term in fixed income. So anything between 3 and 5 years is a typical business cycle in India, which means you'll see cyclicalities of something going up and down both at the same time. So your investment period in a long term thought process should be at least 3 to 5 years. And unfortunately, it may vary very dramatically. For some people, it may be a 30-year time frame that sounds reasonably long term because they're building assets for really, really long term. For some people, they have specific goals that need to be achieved. Let's say 5 years later, let's say 10 years later, or something like that. Retirement, children's education. Any of these become interesting long-term goals now. But the closer you are to that goal, it may not be a long-term goal. So for me, for instance, when I started the Capital Mind PMS myself in my own account, my son had about 5 years left or 6 years left to go to college. Now he has only 2 years left to go to college. So today, if I were to start a PMS, I would not start it for him. 4 years ago, it was perfectly fine. So long term, I think, is also the nature of how much time is left to, to get there. But anything less than 3 years, I would say typically not worth the effort.
Just a few points to make on that. One, I think we'll bring up your son's experience later on when we talk about different types of customers, because I think that's gone very well for as an example of a successful PMS use case. Two was, as you said, you have to have all three. So you could frankly be very good at investing and have the want to do it and maybe even have the skill. But if you have a super demanding job or super demanding personal experience, whatever demands on your time, then you're setting yourself up for failure in a sense, because you'll just never be there at the right time. You'll be occupied elsewhere. So that was that. I wanted to ask one question before we just move full on into the world of long-term investing and mutual funds and PMSs, which is, so what do you do about the short-term money that you have or your short-term needs?
Yes, absolutely. In fact, the short-term money is where a lot of people get really excited, right? So I made 15% last month. I put this money in and 3 days later it had doubled. All of this short-term thing has two aspects to it. First, there is short-term money that can't be risked. Simply because, let's say, my son's school fees, they're supposed to be paid on October 15th of every year and February 15th of every year, roughly, the kids' school fees. This is short-term money. This is not something I want to put into equity at all. At best, it will go into an arbitrage fund. At worst, it will sit in a bank account as a fixed deposit. You don't want to put any of this short-term money which is actually going to go out of your account. Like I know people who have income tax payments. Now there's a payment in September, there's a payment in December, there's a payment in March. You just put money in a fixed deposit for that much time. Don't try to push it into equity or something that's risky. Something that's really short term, from a liquidity need perspective, I would say don't risk it at all.
So that's fixed. But what about if you want to take some risk and there's a little bit more money, you've got maybe a bit of a bonus or something just worked out for you in life and you're like, I wouldn't mind some entertainment with this. What do you do with this gambling wala short-term money?
You've hit the point here. It's not just that. It's that every one of us has an itch. There's a little bit of FOMO somewhere, right? So somebody's talking to you and saying, oh, you know what, I bought this I don't know, Mazgaon dock and it's up 3x in 4 months. And you're like, wait, can it go up more? Yeah, there's another 2. So the person's telling you this and you're getting excited and you're like, I should put some money on this. The problem is, nobody knows how much, right? So you go and put 10,000 rupees in it, it's a waste of time. Because it just gives you bragging rights. And if you put like 25% of your portfolio on it, that's just dumb because you have no idea what you just did. But what do you do? What's the framework? So my funda is this. I am not the kind of person who will say, don't do this. Because this is like telling my kids, don't touch that or don't put your finger in that, because they're going to do it. Even if they had no idea that this should not be done or this should be done. The moment I say this, they know. So the point that I'm trying to make over here is do it. Because it's going to scratch that itch. You need to scratch that itch. And that's what life is for. In the end, you're just going to... It's just
this is what life's about. So
yes.
1%.
Yes. So 1% of your portfolio and put it in something like this. So if you have a 1 crore net worth, put 1 lakh into this.
Every year. Because you'll probably lose it every year,
You'll probably end up losing it and you don't care, right? It's just games. Think of it as you go to this place where you went to a casino and you played and you had some entertainment and that's what you paid for. But you don't put too much money in a casino and you don't put too much money into this kind of thing. If by doing this you find out you're really, really good at it, then you can manage your own money. But if you find out that, look, dude, you know what? I am not really. In fact, what will happen is mostly you'll start up. The worst thing that will happen to you is you will make the first fantastic trade where you would have done like 2x in like 6 days or something like that. Then you will start feeling you're the hero. And you might continue to be a hero because it's one of those momentum type markets. And when the momentum stops is when you suddenly realize that, oh my God, I'm not ready for this kind of volatility. Because even at the 1 lakh level, a 30% drop makes you not just feel miserable because it's 30,000 rupees gone. It's the feedback the market gives you that, boss, you are not Bhagwan, right? You are just another ordinary mortal who we can bash up anytime we want, which is unfortunately something that we are not used to in character. Most of us, most of the people reading this are relatively rich. They have achieved a lot of success in their lives. They probably never failed in any exam. They have no market feedback the market
They're
feedback.
probably doing very well in their careers
and
or
so
business.
You can't handle somebody telling you that you may not always be right. So this learning comes over time. Build this, I think this short-term thing is just great for a small part of this thing. Use it as the learning experience, educational, school of hard knocks kind of experience.
Fair. So I think this deserves its own conversation actually at some point, because I think some of these, there's a lot going on in the short-term space, but I don't think that belongs in today's conversation. So long-term it is. What are my options available? You've discussed the big two, right? Mutual funds and the PMS. Let's get into them. Why not mutual funds? Or what are they good for?
Oh, this is perfect. In fact, here's the thing. For most people, mutual funds might actually be a great alternative that you could invest in. I tell people this, and the first thing they say is, which mutual fund? At which point I'm stepping into advisory land, right? So because I'm looking at the problem at this as, now there are 3,000 mutual funds. And maybe there are 700 mutual funds, with each one having a growth and dividend option, with each one having a regular and direct option. You don't know which ones to choose, because by the time you've learned about all of this, you've spent a considerable amount of time just understanding what the whole protocol is. Now, once you've figured out that the landscape is X and I need to choose between 3,000 funds or 200, 500, 700 funds, it's still a lot of work. How do you choose between one mutual fund or the other? An advisor may be your approach over here, because they will say, okay, well, there are mutual funds and there are advisors who help you get into mutual funds. Now, the advisor by nature can only tell you what you need to do, and then you have to execute on it. That, for instance, to give you a craziest example, till a few years back, when you invested 1,000 rupees, you got 1,000 rupees worth of mutual funds. Today, you will get 998 rupees worth of mutual funds, and you don't know why. So you probably go back to your mutual fund advisor and say, why have I got this much? The mutual fund advisor will say, well, you got this much because there is a 1.0 something, I don't know what it's called. It's a stamp duty. That stamp duty takes away from your return. You're like, okay, but I invested 1 lakh, it's showing me 90. Okay, fine, we'll do this at a later point. And then, you suddenly start feeling like the execution is your headache. You've done the execution. You still need to work backwards and do something on it. Now, at some point, people are like, dude, I don't have the time or the discipline. And, I want to just outsource this.
So distributors kind of take that, the regular mutual fund people.
They do. They take the role of
handling
the execution part of things. Let's say they took your money. They can't take your money. Your money has to directly flow from your bank account. But so they may require an OTP or something from you. Earlier they should take checks and all that stuff. But let's say you do this transaction even by yourself onto one of these platforms, and then the money goes. Now the advisor may take money from you separately, and the mutual fund may take money from you. If you go through a distributor, the mutual fund takes double the money from you and pays. And you find out about this later. After some time, the best thing about mutual funds is they're long-term investments, right? So typically, if you invest in one mutual fund, you just continue to invest in that mutual fund. Now think of year one, you've paid your fees, somebody's done all this fantastic research and said, listen, these are the funds you need to pay for, you need to buy. The next year, you say, I have more money, what do I do? They'll say, well, you know what, put money into the same mutual funds. Because they did the analysis. Why would you do the analysis to invest only in 1 year in a mutual fund? And then you're like, acha, you didn't do any work. You just told me to invest in the same mutual fund. Why am I paying you in any meaningful way? You start to feel this relationship where you don't know whether that person is actually working on your behalf, or is it working for his own commission, or is it like something else and all that stuff.
Or not doing anything.
Or not doing. And so in the sense, they're just like, oh, you know what, this guy's come back. Let me just give him the same mutual fund. He won't know, he won't realize. It's like, in my college, there was a dispensary where there was a doctor, and for every, you could go in there with a headache and he would give you Calpol, and you could go in there with a broken arm and he'd give you Calpol. And if you for instance were on the verge of dying, he'd first give you Calpol and then try to give you like emergency whatever this thing. So the idea was Calpol was the be all and all. You don't want to be the Calpol recipient, right? Because you want to be like somebody who's like, no, I need something that
personalized kind of.
Not so much personalized as I need to know that you've done the work. So if you're doing this for 100 people, that may be one thing, but I need some kind of feedback loop. And then there's this other problem, which is that the person may forget or not be, because they handle hundreds of customers, they may not know exactly what you own and may not have the expertise to deeply analyze some of this stuff. And I'm not saying that this is a feature for all these things, but the typical advisor or distributor is your bank manager. That you've gone into the bank, the guys looked at you and said, sir, I wear a suit and please buy this mutual fund. Which is pretty much the qualification at this point.
By the way, I don't think people wear suits in banks anymore.
In Bangalore, no. Yeah, you're right. But okay, they would just wear nice clothes. They speak nice English. But they tell you that, but the problem over here is the guy does not have any expertise at this point. In all probability, if there is a Franklin-like situation in a fund that you've had, and Franklin is a situation where the debt funds suddenly told you that you can't exit those funds because there's some trouble, etc., etc. And your money is stuck for 2 years. What do you do? Do you stay? Do you not stay? You can't not stay because and then is it a good thing? Is it a bad thing? Did you know of this problem upfront or not? Many advisors knew about this, but a very vast majority of people that call themselves advisors had no idea what hit them. And I think if you ask them about the ILFS crisis, if you ask them about why certain small cap funds fell, they'll just tell you, oh, well, the volatility, they keep falling 30-40%. But there is an advisory relationship that requires you to be fiduciary in the sense of you should think in the best interest of your customers. Sometimes the advisors don't have that expertise. So what happens is you need help selecting the mutual funds. The advisors are one layer. Now, you want this advice to be bundled in with execution, and the combination of the two can be made available in a PMS. And I'm not saying that the PMS should bypass the mutual funds. A PMS is just a vehicle. Think of it as the advisor, like I said. It could invest in stocks, it could invest in mutual funds. Effectively, it's that execution plus advice combined in one entity that can help you make a more informed decision. Mutual funds by themselves are great. I think they're good vehicles, good long-term vehicles, except they are blind to who you are. So in the sense, you still have to make the decision when to get in, and you still have to make the decision when to get out.
So I'll make 2 points here. The first is we've had experiences of people who, let's call it their distributor or their advisor, forgot they had Franklin. So that's one example of a failure case. And the other one is, which is I think what you're saying, I'd just like to elaborate on it a bit more, is there's a very large universe of people who'll help you with, say, investing in mutual funds. And not all of them are as qualified as each other. Some of them understand this a little better. Some of them have done some fairly basic analysis, which should work most of the time, but sometimes it doesn't. And at that point, you may not have realized that you don't have access to the person who actually knows what the mutual fund owns and his inability to tell whether this debt mutual fund actually owns riskier paper or not. And again, 9 out of 10 times this won't matter, but every now and then it does. And I think you wish you would have known in advance. That's perfectly fair. I'd like to go to another version of investing in mutual funds. Do it yourself. I hear what you're saying, but here's my crude and on the spur of the moment solution. Every year, buy the top ranked large cap, the top ranked mid cap, and the top ranked small cap fund. 3 funds a year. Just buy, let's say you have 3 lakhs to invest every year, put 1 lakh in each of them, and then come back next year and then just buy the top 3. You're going to accumulate a whole bunch of mutual funds. I get it. In 10 years, you'll have maybe 30 or some less. But this way, you're never too exposed to one fund unless it continues to do well. You've done some extremely basic analysis, which is like 5 minutes a year in this case. You don't need anyone. What's wrong with this approach? Why can't I do this? Won't I do particularly well?
This is actually a very interesting point, because what will happen over a period of time? And the first year is great, right? Because you do this. And there are 2 aspects of this that are troubling. One is that mutual funds that are top ranked in any year are not necessarily top ranked in the subsequent years. So you might find 1 or 2 years of consecutive high level performance. We may not have a lot more of that stellar outperformance lasting in the future years. So what happens is the top lists change. So over a period of time, you're buying A, B, C, then you're buying D, E, F, then you're buying. So in the end of about 10 years, you have about 30, 35 funds which are sitting on your return. Now, by and large, I don't think the numbers matter. So it should be fine. But suddenly when you start looking at it from that point onwards, because you have 30 funds and because some of them did really well in the past, not doing so well now, some of them are doing well now but did not do so well in the past, your average returns of the current portfolio are equivalent to having an index itself. Somebody's going to point this out to you. So 30 funds है क्या है तुमको तो index return मिल रहा है. Now suddenly you're like, oh shit, I should be rebalancing and going, so I need to sell something and put something into the top this thing. Though there's administrative overhead for all of this stuff, which means you have to suddenly, not only have you made the decision every year to do all this stuff, after 10 years you're going to have to make the rebalancing decisions. The rebalancing decisions may not work out necessarily in your favor. You don't have the time to do all of this. You want to sell, but which one do I sell? So I sell the worst performing or the best performing, because the best performing is not going to be the best performing next year. Should I sell it now because there will be a tax implication, or should I sell it 1 year later because, there's an exit load for 2 years? At some point, this starts to bother you. But the biggest thing that bothers people, and I've seen this though, and it's fair also, is clutter. You have too many items of food in the fridge. You want the number of items of food in the fridge to come down. So you kind of consolidate, you bring them down, you get rid of stuff that is a little bit closer to their end of date and so on. I think you do that with your portfolios once in 10 years. You can look at it and say, my God, why do I have all this stuff? Let me clean it up. Even though the clean it up does not make any major difference, there'll be a stock which you own 7 shares of. But you'll be like, let's sell it, because having 7 shares, of course, does no difference to you. But you have to remember that even the point of saying sell those shares and actually executing on that is work. So clutter builds up and then adds to your stress, because at some point you're like, I need to fix this and I'm not fixing it and I need to do something about it. So it's the same as inbox clutter, and some people love inbox zero. I have inbox 10,000 or something like that, but I have now made my peace with it that I cannot get to inbox zero. But I don't think I can do that with investments. I can't have 10,000 investments and make my peace with it. And the last bit, and I think this is the most important, you simply do not know how much return you've made. You've done this thing over 10 years. You might not have had the same amount of money. You said 3 lakhs the first year. Next year you might have had 4.5 lakhs. Then you might have had a bad year, so you didn't put anything. The fourth year you put in some 7 lakhs. Now you thought that you've done the right thing, except how much have you invested, at what points, what's your XIRR over the entire portfolio. What the portfolios will show you is you have 20 mutual funds. One guy gave you 43% returns, one guy gave you 7% returns. You don't know whether the 7% return is a guy who you invested in just 3 months ago, and therefore that 7% not representative of like the entire time frame. But you just look at this as a list, right? So you don't know what return you've got overall, whether your strategy has worked or not. And if you had put the same cash flows into something as simple as the index, would that have given you a better return? So you need something, some kind of software to consolidate all of this for you and say, okay, boss, if you're done what you just did, in the same thing, if you did it in the index, you would have gotten a certain amount of returns, say 17.5%. You by yourself did the whole thing, you got 16.5%. So pretty much, you were useless. Your strategy was not great at that time. Forget now. Take any 3-year interval in the past. Let's say those 3-year intervals, whatever cash flows you gave in, you invested in the Nifty versus investing in whatever you did. Only 30% of the time were you actually beating the index for all the choices that you made. So it's not based on where you are right now. Today may be a particularly bad day, but it's not just about today. It's also about the past. We checked up the past. And so somebody needs to have done this analysis and told you that, listen, your returns are X. The idea over here is there is altogether too much complexity which comes with decision making when you're doing this yourself, but that decision making complexity coming down the line. And typically we see people who have done it themselves, reach a certain point in their life where they're saying, I need some help on this. This is just too large for me to just dump into one mutual fund because I have mental problems assigning 45 lakhs to one mutual fund and 30 lakhs to another mutual fund. I don't know if the right decision to make. So I need some help in doing this. So you're going away from do it yourself to something else. And again, the point is you're probably enjoying your life doing other things than this in the first place.
Yeah, if you're enjoying your life doing this, you probably have the trackers built up so that you can see by year how has each cohort of investments done and all that good stuff anyway. So if you're that person, you're probably not listening this deep into this podcast episode anyway. You're already off investing and having fun with it.
And worse, what we're saying, sending a subliminal message saying unless you have all those trackers in place, you're not a great investor.
I mean, if you can live with as you said, if you can live with the clutter, maybe you'll do fine. But most of us struggle to do so when at one point you wake up and you see all of these and some of them seem to be doing very well and some don't. You're sort of forced into a decision. And you may need money. And then which one do you sell, as you pointed out? So, okay. Sure. Fine. So moving to the PMS. Look, you already described it sort of at a high level. But thinking of PMSs, can you expand a bit more? What really do they offer and what does the customer get out of this? What's the benefit that the customer gets?
I think the biggest benefit here, Sri, I think is that it lets someone else manage your money without you having to worry about it too much. Now, you might say this is true for mutual funds as well. And I said the problem with mutual funds is you still have to make those decisions. Over here, somebody else is deciding what to buy, when to buy, how much to buy, and when to sell, how much to sell, when, and all of those decisions are being taken by a third-party person. And you are getting informed at the other end about how much your return has been, how much has your return been with respect to the Nifty. If you've added more money every month, every year, every quarter or something like that, they have taken that into account in calculating your total XIRR returns, which is the internal rate of return. So effectively an annualized rate of return that you've received and an equivalent XIRR that is available for the Nifty. I think that's there's a CAGR versus XIRR argument, but effectively they will give you a return dynamic that will tell you how much your funds have done and how much the Nifty would have done in the same time frame. This is by regulation, so it's not just that Capital Mind does it, but that everybody does it. But is PMS the most optimal investment? Now, I want to come to a more philosophical point over here. nothing is optimal in hindsight. Everything else had a more optimal solution, unless you've been that 1% path breaking thing, that thing.
And you bought crypto in
And you
2016.
and you sold it at the peak and so on. So you an optimal solution may have been to do an MF analysis every year and then figure out what would have been the next one next year and but at some level you have to ask yourself, is this going to give you a lot of happiness? You want to optimize what makes a difference in your life. I want to optimize, for instance, what car I want to buy. I want to spend a lot of time on that. I love it. But do I want to spend a lot of time looking at which investment did what when I'm not even interested in it in any meaningful way? And this is not me, of course. I am very interested. But assuming that a person living a normal life and they may spend 6 hours deciding which cycle needs a Shimano gear versus a something else gear, and what kind of brake do you want, a disc brake, do you want a caliper brake, all of that stuff, because it's exciting, it's great, I cycle, I want to do this stuff. But the minute you bring in I have mutual fund A, B, C, D, large cap fund, and mutual fund D, E, F, G, mid cap fund, which one should I decide? And then I am here like Deepak Shenoy saying, you put all the returns in one spreadsheet, see the 3-year returns, 5-year returns, 7-year returns, calculate how many times you would have beaten the index. You're like, dude, I would rather spend 6 hours on a cycle than 6 minutes on this thing, right? So it doesn't give you that happiness that you need, that you're going to get in your life. So you may not think of PMS as an optimal investment, but anything that is perhaps optimal requires a lot more work from you that is time taking and not fun. In a sense that at some point you want to trust someone else with your money. You're going to have to trust them to make some bad decisions and some good decisions on your behalf. They will not always be all good decisions. But this is also what gives you happiness, which is why I tell people, if you're in the short term, put your money in FDs. It's not the most optimal solution. Probably the most optimal solution was liquid funds maybe 8 months ago. It's no longer that. It's something else. Probably ARB funds today. But I would say this doesn't make any difference. You don't want to worry about what you've invested in 2 months down the line or 3 months down the line. You want to reduce the impact of it. So I think you want to think of a PMS as outsourcing the headaches. Gives me a better feel compared to a mutual fund because of the size. And I'll tell you, this is for me as well. I've invested in mutual funds. I've always felt uncomfortable when they get beyond a certain size. And ever since I've gotten the PMS, I have no problems with the PMS being a significant amount of portfolio. Not just because I run it, but because I know what's inside it and how diversified it is inside that portfolio. So it's not one fund that I'm buying. I'm actually buying a portfolio of many different things inside of it. This, I think, also has a problem of institutional risk, because you think of, I don't want to put all my money behind an HDFC or an ICICI. Here, you're not putting all your money behind an institution, because if Capital Mind PMS does not exist tomorrow, all our customers' shares are in their own demat accounts. The cash lies with the custodian, which is ICICI Bank. So unless the world wipes everybody out, in which case it doesn't matter, you're actually in safe hands. You know exactly where your money lies and where your securities lie. So in that context, you are in better shape than entrusting yourself to an organization that might do this in the first place. In the US, you have a very interesting concept. Okay, so you have something called an IRA, a retirement account, a 401k, and so on. People who are advisors can actually handle your IRAs. Now, the IRAs, many of them are very interesting in the sense that you put pre-tax money into it. Think of it as, before you pay any tax, just put money into this. And when you take out the money from this IRA, whenever you do, that time you'll get taxed as if it's income. Now, the good thing about something like this is that it will defer your taxes till that time. So if you get 100, you would have paid 30% tax, got 70 out of it. You could have invested that 70. Now you can invest the 100. It makes you feel a little bit richer.
And the hope is, of course, that when you withdraw it, your tax rate will perhaps be lower, or you can time it to perfection and take it out in a year when your tax rate is lower. And so maybe you'll save, first it grows now, and then you only pay 20%, say, instead of 30% that time.
Exactly. And we know that, tax slabs keep going up. So hopefully
Maybe,
at
yeah.
some point you'll pay a lesser. Like you said, if I only today, for instance, I couldn't have imagined this 10 years ago, that today if you withdraw 7 lakhs per year as a single individual, you don't have to pay any tax. That's 55,000 rupees per month that you don't have to pay any tax on. So you had a couple, you can withdraw 1,10,000. Now I know that 1,10,000 is a very decent life for a retired person who already owns their house and has very little obligations and so on. A very decent life. I'm not saying it's a great life, but it's fairly
and
decent.
this number will presumably only go up every year.
Yes. So you could literally withdraw your savings out at those rates and not pay any tax. For a person who saved for the last 20 years, today 1,10,000 rupees for a couple is feasible for the rest of their...
And retired people who are quite delighted with this situation.
I mean,
Yes.
they just love it. I mean, the fact that they don't have to pay any tax on 11 lakh or to a 13 lakh kind of income is fantastic. So I would say this is one of the things that PMS should be able to do as well. So eventually when India has its own retirement accounts, it will not allow people to defer tax. It will allow people to say, I know I'm doing this, but you know what? Where do I put this money? Currently, the funda is, you know what? We will tell you. The government is saying, we will tell you where you should put your money. Put your money in EPFO. EPFO goes and decides what they want to buy. Put your money in NPS. So NPS manager decides where you want to go buy. You don't have any control over that kind of situation. In the US, an IRA can be controlled entirely by you. You can say, I want all of my IRA to go to Cisco stock. I want all of it to go to Amazon stock. Or you can just simply say, I want a CT or a managed advisor to take control of my portfolio and invest it in, say, a combination of index funds in the US, a combination of worldwide index funds, and some biotech stocks, which I like. Perfectly fine, valid experience. I think that's the experience that should come to India. And guess who will be the only set of qualified managers, advisors who will be able to advise and execute on that portfolio? The answer is a portfolio manager. So I think that will be the future as well.
Fair. I'll ask a question in a different way. So let's say that you're initially investing in mutual funds and direct stocks and whatever, and then you cross the 50 lakh mark, and so now you're above this. Should you be graduating to a PMS now that you've crossed the 50 lakh mark?
This is a great question. I'll tell you why. Because I think it's like when a person reaches a certain level of wealth, they feel they should have the iPhone, not the Android phone. They should have the... I mean, it's not...
You of course haven't switched.
I have, unfortunately, I have... or fortunately, I don't know. I mean, I don't know the answer because I'm just too married to, say, the Windows world. I know which people hate so much, but I've kind of grown up on it, so I'm still comfortable with the shortcuts. But also but it's also a status feeling, right? So it's like, is PMS a status symbol? I think to a certain extent, it may be, in the sense that it's only for people who are more than 50 lakhs. So by the virtue of having a PMS, so for instance, you could ask people for an iPhone charger. And if you ask people for an iPhone charger...
None of this matters anymore. They've all moved to the same one.
Which apparently is one of the unfortunate consequences. And some stand-up comics said this, अब मैं लोगों से iPhone charger मांगूंगा तो उसका कोई meaning ही नहीं रह जाएगा types. So which unfortunately, I think PMSs are not supposed to be these high funda vehicles. But I think what they are really is vehicles that help you better, and because they're 50 lakh plus, they're able to do things which a mutual fund... So a mutual fund can't give advice to its customers. By nature it can't. And then an advisor can't execute. That means advisor can't buy stocks on your behalf. So when you marry the two, you've just made the barrier for entry a little bit higher. That's what it is. But I think a PMS is just an intermediary. You can buy, a PMS can buy anything. It can buy mutual funds. So some of our customers have done that. You kind of say, telling the PMS, I authorize you to buy and sell on my behalf. A PMS can perfectly well buy mutual fund. A lot of our customers have mutual fund portfolios with us. They're very happy customers. Now we can have opinions on stocks because we have a research team there. We have our opinion on mutual funds because we have research there. We can create portfolios of stocks. We can create portfolios of mutual funds. It does not have to be either or. It can be a combination. Some mutual funds, some stocks as well. Now, there are certain people who have to. So, for instance, a promoter in, say, a group of companies that has a holding in a large number of public listed companies. Now, they're like, dude, we're directors. We don't want to be directly involved in stocks. Pata nahi kal kuch ho jayega. Please don't buy stocks for us. we'll buy you a mutual fund. Some people who are lawyers, who's as you know, there are corporate lawyers who are barred from buying any company that the corporate law firm itself may be dealing with. Now, who knows? Today you're not dealing with Reliance. Tomorrow you could be dealing with Reliance. Suddenly you can't go to the PMS and say, "Hey, dude, I can't buy. Don't buy Reliance for now to 3 months later." But we may get another case, so it could be 6 months later. But so a PMS can't do that, and it's not viable to do this. So you simply say, "Listen, buy mutual funds for me, and I'm fine." I still have the same problem of not being able to select and all that stuff, but not because I don't have the skill, but because I don't have the time or the inclination. So I think even some of the bankers, people who deal with companies, they like to be too senior in the organization to risk a SEBI coming and giving me a black mark and then my promotions getting halted. So I would rather do a mutual fund portfolio. Now, a PMS portfolio, one of the ways that perhaps a PMS could get exposure to things that it cannot directly invest in. I'll give you an example. We could directly buy bonds, but instead we could use a mutual fund to get access to the bond market, because each of our customers is 50 lakhs. The minimum transactable value inside of a debt market, wholesale debt market, is 5 crores. So unless a customer gives me 5 crores, I can't buy 5 crores for that customer, right? So I'll have to pool it together and then I may have 9 customers. And then what do I do with their money? If I have to should I wait for the 10th customer and all that stuff? So the idea is to get access to those markets. A PMS may use a mutual fund. Think of markets abroad. A PMS is not allowed to invest abroad. Now, I will fight that. I want SEBI to allow us to kind of invest abroad for our customers, because we are effectively advisors to the customer's wealth, but currently we cannot. But we choose, let us say, a mutual fund that is allowed to invest abroad, and we use that mutual fund to get that necessary exposure.
Or an ETF.
Or an ETF. So we can do it in that context. So these, I think, are reasons why PMSs can be used to invest in mutual funds, given all the other reasons remain the same. Now, I know it's popular on Twitter, or X as it's called today, that boss, just manage your money, don't pay anyone in the middle, you're the guy, you're the person who does it and all that stuff. It's very stressful not just to read these tweets, but to also try to execute on them, because at some level you've kind of come to an understanding that, boss, I don't have time to do all of this stuff on my own. I don't want the range of emotions to come beating me up every few this thing. But if you have that level of interest, I think you should just do it. It's like scratching that itch.
But I mean, just to add another point here, I get none of these things end up being as hands-off as you like, unless you've given it to a PMS. Like, for instance, if you buy some stocks directly and so on, you still have to deal with buybacks on your own. Your tax filings are, well, even in a PMS you have, but as you presumably the PMS will give you the tax reports like we do, and they're fairly detailed ones. And you still have to then coordinate with your CA, who may be like, what the hell is all this? And I need more time and so on. So I think that advice is well made, that do it yourself is demanding on you in several levels, and you may need to have infrastructure, both people or time, or your own skills and time to do it.
Yes, I think the simple idea over here is that the PMS saves you the effort, the time. They consolidate a lot of this stuff for you, so it comes into one place. Like you said, just avoid avoid getting into an analysis paralysis kind of situation as well.
Okay. I have my next two questions, which are, TK, you've talked about this structurally, and I get that completely. And I think that argument is now extremely elaborately made. So I'll go to two things. Can you tell me a bit more about what a PMS can do differently? And then we'll come to the next one, which is, and I have some thoughts on that, which is, look, at some level, though, if you're doing this, you want it to be better. And by better, we do mean better returns. So how does that happen, or how can that happen? So maybe these two questions are linked.
Got it. Awesome. So here is where a PMS may differ from the traditional vehicles of a mutual fund or an AIF or something like that. First level is concentration. So sometimes portfolios need that level of concentration. Let's say you bought a stock, you give it a 20, let's say 8% weightage in your portfolio. Now, for whatever reason, that stock tripled. Now it's 20% in your portfolio. A mutual fund cannot have owned this stock, because a mutual fund is limited to 10% per stock. They cannot go to beyond 10% unless it's part of an index. But let's leave that aside. PMS is allowed to concentrate way more. So it can have even 40% in one stock. It can have 70% in one stock. It's perfectly fine. The second, the concentration impact is useful because this is a managed portfolio. Now think of it as, if you know what you're doing, you can concentrate. If you don't know what you're doing, you need to diversify. I'm saying not. So sometimes there are too many factors, luck and external forces that will play a role. That time you're not so confident that your investment will always have the best return. So you might want to diversify between 20, 25, 30 stocks. But I personally, for instance, if you ask me, I'll focus all my energy on Capital Mind. If Capital Mind was a listed entity, I would buy all of the stock, all of my stock would be there, but not because of any diversification reasons, because I can change the outcome. And many fund managers are somewhere in the middle. They're like, dude, we love this stock so much, we can be 30% in this stock. We've done so much work on analysis on it that we can be 30. That's the concentration concept. The other one is that you can actually divide your portfolios into equity and debt. Equity, debt, remain a little bit in cash and go to cash. So we did this in the momentum, and this is me showing off on our end. We went to the momentum portfolio, we went to cash because the algorithm told us to go in cash. So we almost grudgingly went to cash in March 2020 before the disaster hit us. So our stocks, while they fell for 15%, the portfolio stopped at 15% down. Whereas the Nifty went all the way to 39% down. So if you held a portfolio that went 39% down, of course it recovered after that. But the point over here is that you fell less when you fell, and that's because of the cash component in your portfolio. Over time, this can be a benefit in this thing. Now, another thing is you got FlexiCap. FlexiCap typically... Now, if you keep increasing AUM at some level, most of your investments end up in large cap funds. Today, the largest Indian mutual fund is a mid cap fund. Imagine what it has. And if you look at the portfolio that it has 9% in probably Reliance or HDFC Bank. So it becomes a bit of a problem in that sense. But PMS can be across multiple market caps. The only equivalent is FlexiCap in the mutual fund universe, because a large cap, they all have different requirements and they have to be in certain asset classes. PMS can be a completely small cap portfolio today. 1 year later, it might be a completely large cap portfolio. It can move and interestingly, it can get to much smaller companies than mutual funds can. Mutual funds typically want companies to be at least 4,000 or 5,000 crores in market cap, because when they perform, they get AUM, and when they get AUM, they have to invest, and they want those companies to be investable. A PMS can be a very structured, listen, I want to do a 500 crore PMS, and I'm not going to take any more money beyond 500 crores. And that 500 crores can be invested in micro caps. And because PMSs say they know what they're doing, they can figure out how to get in over a period of time, not all at once. Have a certain... so for instance, a small cap fund is allowed to have only 35% of cash, 65% mutual fund. But a PMS can have 80% cash, because the guy is looking at it and saying, we don't have enough opportunities right now, I'll slowly build up the position. These are flexibilities available to a PMS that is not available to a mutual fund or an AIF.
Can we come to the returns point? And I'll just tell you my personal, what's the right word for this? Shift in perception over the course of less than 1 year. In January, when we held that town hall, I think the sentiment, at least that I felt, was the Nifty is such a formidable competitor. It's, I think, 3-year returns were 20% per year at that point of time or something like that. And it felt like that was pretty good. I mean, and if you can make 20% on the index, then isn't that really hard to beat? And you could kind of get it tax-free if you, or tax deferred if you just invested in an index fund and sat on it. But now 10 months later, everything feels different. The RPMS portfolios all seem to have beat the Nifty on that comparison every single time frame, which is great, of course. And now the number that I for some reason remember is not some 3-year number on the Nifty, but the 10-year number on the Nifty being, say, 11 or 12%, which suddenly feels very unimpressive. So I'm obviously experiencing what everyone else experiences. Maybe you could just help me understand both how I'm looking at this, and can a PMS conceivably or realistically aim to beat the benchmark, which I guess would be the Nifty in this case, and show you that justify you going through all this effort?
I think that's very, very valid. See, a lot of times... people come to us primarily for returns, and then they stay for the other stuff. But the idea over here is that your PMS returns can be controlled by concentration by cash. So you can actually get a better return because you concentrate on the right kinds of stocks, or you could get a better return because your drawdowns are controlled because of going to cash. The returns, of course, do have a higher taxation. But this isn't such a big deal, because what I mean to say over here is the longer term return, let's say in a mutual fund, in a PMS, if you buy, if a PMS buys a stock and sells it within a year, you pay 15% tax. Similarly, if someone else bought a stock and held it for a year, they would pay 10% tax. If you bought a mutual fund and sold it after a year, you pay 10% tax on the gains. So the difference between the gain returns is 15% versus 10%. So, significance of this is, if I made 12% returns in a mutual fund, and I would have to realize those gains at some point in time, those 12% returns would translate to 10.8% because I have to pay 10% tax on that 12%. So which means my return post-tax is 10.8%. If I bought into a PMS which gave every single trade only a short-term gain, then what kind of returns must the PMS earn? And the answer to that is roughly 13%. So it's not significantly higher, in fact 12.5 or 12.6%. So it's not significantly higher than what a Nifty has to earn in order for the taxation to kind of get equalized. But you do have to understand that one part of it will never go away. Dividends are taxed in your name. A mutual fund allows dividends. So these taxation differences hurt your overall returns. Still, I would say a PMS can wiggle out substantially greater return. Now, look at our own returns. For the last roughly, I think, 4.5 years since we've started a momentum portfolio, from the inception itself, it's been beating the Nifty significantly. Even over the last 1 year or 2 years now, though it had a rough time in a 2-year time frame for a while, 3-year time frame or a 4-year time frame, you're looking at returns that are significantly higher than the Nifty, and not just a little bit higher, but a significant amount higher. And we'll come to the numbers a little bit later, but these numbers are also available with other PMS. You can see how their returns have significantly beaten. There's a good set of reasons for this. A lot of stocks are under-researched by the mutual fund, the large cap, the large institutional community out there. The PMSs fit that gap because they go into the smaller and mid caps. They have a better understanding of those universes. Some of them are very focused on certain sets of stocks, and therefore they can wiggle out a better return. I think big thing about Nifty is this. The Nifty's returns are great when foreign investments is very, very strong. So if you look at 2009 and 2014, all of these years there was a lot of activity from abroad. At that time you saw the Nifty going up like crazy and comparatively as good or better than the mid and small caps. 2013, 2017, in fact 2022 from August also, from January also, you're looking at a point where the small and mid caps have gone up, but the Nifty hasn't. That's because foreign investors has been relatively lackluster. I'm not saying it's been totally lackluster, but it's not been that much in comparison with the past itself. So you've had a period in which the Nifty has primarily benefited because of foreign investment. So it's years like now that will make the Nifty look poor versus a mid cap or a small cap fund, which is also why perhaps the PMSs look better.
So returns are lumpy, deal with it, and I think that's the point there. Different end of the question. Who shouldn't invest in the PMS?
This is superb. In fact, I think the first thing I'll say is, if you think of it as a status symbol, you'll say, the minute I get 50 lakhs, I want a PMS. I think that's a bad idea.
I certainly hope no one is thinking of a PMS as a status symbol.
I hope not. I mean, unfortunately, people think of the strangest things as status symbols, as I have discovered. But if you only have 50 lakhs, the problem with that is any person who's responsible for your well-being will tell you that, boss, you should not do this. PMS is kind of like a locked-in long-term thought process-based investment. And they are there to advise you, but there for the longer term. They're not out here to make you a short-term kind of a profit, for the most part. At least all the PMSs that I know of are only thinking long-term. Now, given that, can you give them money that is your emergency funds? Answer is no. It should be with you. You should have money for your short-term needs, your kids' education, school fees, anything that you need for the next 1 or 2 years, you need for yourself. So if you have only 50 lakhs, it's not good enough. You should have about enough money to take care of your basic needs beyond that, and then you have money to either risk or keep in long-term fixed income. That is when a mutual PMS can help you in a big way. Now, if you want guaranteed returns, that is a sign of danger, because other than an FD, very few things even a liquid fund can't guarantee returns. They can give you a range of returns. The more guarantees you want, the more unfit you are for the PMS, which means the level of guarantees. We get this question all the time, Deepak, how much returns will you give? I don't know. I'll give you a framework to think about it, but I can't tell you what returns we'll give. And you know what? Every framework we've used, we've actually beaten it right now, but it could be the other way in the future. But people know, they want to know. The more questions I get on that, the more I tell people, this is not for you. This is not going to work out, because you'll feel miserable. Because if I tell you 14%, then it actually is 13.5%, you'll still feel miserable. If it's 10%, you'll feel miserable. Minus 15%, you're probably, calling my house every day type thing, because that's going to make you that miserable. I don't think you're the right fit. Now, the other part is, of course, you don't want short-term money from this money. You don't want to say, Deepak, I'll give you this money. Can you generate 1% a month fixed income that comes to me every month? Now, I could tell you that I could do this. I'd be wrong. You can't guarantee returns on SEBI itself. But let's say a person said, Sir, aa jata hai, kaise bhi karke, there are people who sold mutual funds using this kind of technique. The problem with this is short-term money you're trying to finance by using markets, which is probably not the right thing to do. And in fact, I can tell you that, I'll give you an example of what you think is safe. And I know, Shrey, that you'll probably, you face the raw end of this as well. Last year, the US 20-year Treasury bond was down 29%. This year, it's still down 9.5%.
And my exposure is through the TLT, the ETF. I don't know who runs it, but someone big runs it.
Yes. So imagine having a short-term fund giving you 5% a year, and the long-term fund losing 28% in 1 year and 9% in the subsequent year, which has not been seen for the last 10 years.
This is why all those banks went under.
This is also why.
So I'm not alone in my...
Of course, you're better faced. But here is the interesting part, right? So having something like that happen to your portfolio when you want short-term money from it is a bad idea, because then you're thinking long-term, I know, but I know somebody else who's thinking, oh, government bonds are safe, is suddenly like, oh, government bonds are not safe.
So duration is real.
Duration is real. And then if you have a debt PMS, you should really, I'll tell you why, because debt PMSs are not, we use mutual funds to invest in debt so that it's a little more tax efficient, but no longer it turns out. But still, what a mutual fund, what a PMS can do is it can directly buy bonds. And those bonds, the interest and the principal and the capital gains are taxable in your name. Now, what that does is if somebody offers you 12%, you might pay 40% tax on that, and you might be left with only 7.5%, which is your post-tax return. On the other hand, somebody offers you 8%, it's 4.5% or 5%. That kind of capital. So you really know what you're doing at this point, because a debt PMS can easily go into territory where they're giving really non-credit-worthy people your money, non-credit-worthy companies buying bonds of them and so on. So if you don't know what you're doing in a debt PMS, that's pure debt, or if you're not, don't trust the manager well enough, you either need to be a pro at this point, or so it may not be for you. A debt PMS per se may not be for you unless you understand the concept very well.
Yeah, I think I would just second that it's really not for the faint of heart. I mean, you should really know what you're doing, or just have a lot of money, and this is a minor part of it.
Yes, and I'll stretch this argument to say that retail investors investing in shady debt is a horrible idea. Even for the PMS, I say watch and go crazy, because you get a lot of, PMSs are often, people come to people who are like PMSs who control wealth because they have the wealth and they want to pile on their debt obligations because nobody else is giving them loans. And they're willing to pay 13, 14, 15%. So it becomes very difficult to say no. But I'd say a debt PMS that is smart can eke out great returns. Just that you need to be one level more advanced to be able to understand that they're eking you great returns. How?
Fair. I get it. I'd like to move to, I think this is my last question. So who is the right person to invest in the PMS? And could you share some examples from our own experience running this for the God knows how many years about who are people who've really thrived and had a great experience with the PMS?
So great question, Shrey, and I'll put one thread across. Okay, everything is about decluttering your investment thinking, your analysis, and one of the biggest examples is me. And honestly, since I'm part of it, I have to wear two hats here. But I don't have time to think of my own investments. But I have certain things that I really, really need money for. For instance, I need money for my child's education, both my kids' education, and I need money for my retirement. And I'm saving all of that into the PMS. Not because that I'm managing it or something like that. Of course, I'm much more comfortable because we are managing it ourselves. But it also gives me a sense of achievement in the sense of I segregated each child's goal into different portfolios. I was able to set up long-term thought processes saying, oh, you know what? When we started off, we said school will cost so much and college will cost so much in undergrad. Today, that amount has probably gone up 35-40% higher because of rupee depreciation and so on. But I've still managed to reach those goals because those goals were visible to me every single month. So I was like, okay, here's where we are. Rough calculation, I should be here by next year or 2 years from now. That's not going to be enough. Let me add some more money. I wasn't really bothered about the returns. I was more bothered about the number that I needed to get to. Luckily, the returns have also been good. But my point is, I got to the number. Once I get to the number, it doesn't matter what returns I've got because that number satisfies me saying my kids' education is taken care of. And I showed my, of course, I haven't shown them the numbers, but I've just told them that you don't have to worry about your education. You don't have to take a loan for your education because we've kind of saved enough for that. So that gives me that feeling of confidence that, that I think this is that goal-based, goal-oriented approach. You need to reach a certain number and we'll help you get there is one of the approach, one of the success cases for us. It's happened in multiple other customers as well who wanted to reach certain numbers. And in the process of getting there, their rules have changed, their goals have changed, but we've managed to kind of get, I think, some of that in place so that people could visualize it.
So can I call this the goals and abstracted goals and SIP kind of bucket of customers?
Yes. So this is the kind of customer who would say, listen, I'm assuming you'll give me some good returns, but let me just keep money because I need to reach that number. That number can be, 25 lakh rupees for a trip to Europe for a week, staying in the fanciest of places. But it could also be, 2 crores for my child's education because it's 50 lakhs per year because the US has typically cost that much. Now, these are just different ways to get the same numbers, but the idea is to get there. This is one set. And the next set, I think, is also the ultra high net worth investors who simply do not want to worry too much about their money. Now, the examples here are people who have invested in mutual funds through us. Large, ultra high net worth investors who simply say, listen, I could probably do this if I had the time, but I don't. I have other great things to do. I don't want this money to be disturbed. I don't think I want you to risk my money so much that it starts making me worry. I don't want to manage this money myself because I have a better life than that. I just want you guys to take care of it and tell me what's happening every once in a while. And if you have an app, that's great. We can take a look at it, or you just send me a report once in 3 months, which is what PMSs do in general life. But the idea is just a smooth way to do it. They don't need optimized returns. Many of them have invested just in mutual funds, which have gotten, let's say, a few percentage points above in the last few months. Let's say a year
or 1
so.
year, yeah.
They've done better than mutual funds have.
The Nifty has.
The Nifty has. But the mutual fund, it's just a mutual fund portfolio. So it's a portfolio of either stocks or ETFs that simply give you a less tax complicated return. And
no direct stock ownership in your name, so you don't have to deal with the other problems of being an ultra high net worth person.
Ultra high net worth person. So I think that is the second kind of person who simply says, hands off, I trust you. I want you to kind of manage this for me in the longer term. And they're not people who are going to come back and grudge us something like, listen, this particular mutual fund did 45%. Why have you done only 33%? They're like, 33% is good enough.
But I mean, on this, I'll just also give the example of like this diversified basket does seem to, do better than, say, benchmarks by a little bit every year, which is a pretty good place to be by and large. And there are people who've already got rich. And so this isn't the part of their money that they're trying to get rich off again a second time. This is the part which wants to grow relatively steadily or without as much risk and without much hassle. They don't want the money which they've now earned to take over their life. And that really seems to be the person. So even though the sales pitch often goes around these sort of more transactional benefits, effort benefits, headache benefits, the returns are fairly decent as well. I'll just like to point that out.
I agree with you. I think the returns, but the problem is, I think, and this is my problem with me, I keep talking to startup founders and say, I will not be able to match your IRR.
Of course not.
Because there'll be somebody who will be invested 2 lakhs in this company and he makes out with 46 crores. So you're like, there is no way, there is nothing that in the world that I can invest in where you put in 2 lakhs today and 10 years later it becomes 46. There's literally nothing I can invest in that does that. I mean, beyond Capital Mind itself, and then why would I take other person's money to that? So the thing over here is that you simply, like you said, don't want to get rich. People don't want to get rich a second time through their money itself. They might want to get rich through their efforts, but the investment itself gives you a very decent return and it keeps you, anchored to my money is not getting wasted somewhere or risked beyond my imagination. And the last, and this is the most evident of all, is people who come for great returns. They want an exposure to, say, the intelligent stuff we do. We do a lot of quantitative analysis. We build a lot of frameworks to understand, plan the markets. And the idea is that they buy into it and they say, listen, we like what you're doing. Can we put money with you and then hopefully get those kind of great returns that you had? Now, one of our customers who joined us in 2019 with only momentum, and a person who comes to us may actually get a combination of strategies that we might discuss with them and say, do a little bit of this and a little bit of that based on their risk profiles. But there's certain customers who say, listen, I understand, thank you for your risk profile, but I want to do only momentum because that's what I've come to you for, because it's got this quantitative analysis piece which I'm not getting from anywhere else. Now that person, one of those people, is up 165% in 4 years. Now, this is absolute returns. The Nifty is up about, I think, 75% in the same time frame. So it's a fairly large jump between what the Nifty has done and what this particular customer has done. So he's happy in that sense. But it's a little bit different because they're coming to you for momentum. But over time, some of our customers also tell us, sometimes, what if I had gotten in, even the same customers made 165%, would have made probably 130% in 1.5 years. And the remaining 35% in the next 3 years. So the automatic thought process is maybe I could have gotten the money out in the middle and then come back to you later when momentum comes back into the market. All this timing business, we have seen that some of our customers are able to do it, but most of them find it difficult they find it easy to exit, but they never know when to come back. So in the end, the person who benefits most from it is the person who says, listen, you guys take the decisions. You can go to cash. So you go to cash whenever you guys need to go to cash. So you figure out how to deal with it. And over a longer period of time, they've gotten easier. So in a way, people come to us, these set of people, they come to us for the returns and stay for the peace of mind that it gives them. And hopefully get both.
And that's a great note to end on. Thanks, Deepak. Well, thanks everyone for listening. If all these discussions about a PMS have you interested, then do visit capitalmindwealth.com to see if our PMS offering is of interest to you. We charge between 0.25 to 1% with no management fee. If you're more of an email person, then shoot over an email to connect@capitalmindwealth.com asking to learn more, and someone will get in touch with you. The minimum initial investment for a PMS is 50 lakhs as per SEBI rules. Oh, and if you have any feedback or other stuff you want to tell us about the podcast or ideas for new episodes, then just send that email over to podcast@capitalmind.in.